I'm A Trader. We're talking about block traders. It's important to talk about block traders because they make a huge percentage of the volume in our markets. In order to understand volume in our markets, in order to interpret volumes in our markets, we want to understand block traders. Block traders demand more liquidity than normal. They're usually block dealers and block brokers dealing with wealthy people or large institutions. Now, they make a small fraction of the trades, but they are the highest volume. Last number I saw was about 53% of the volume in our market is from block trades. Block traders are always concerned about exposure and honesty. Definition of a block trade is about 10,000 plus shares. It represents more than a day's trading volume. If it's an active stock, it's more than a quarter day's trading volume. Problems of block trading. To understand block trading, we want to understand the four problems: latent demand, order exposure, price discrimination, and the asymmetric information problems. The latent demand problem. It's finding traders to trade with. Traders who would trade if they were asked are out there, but they don't expose themselves. There's also traders out there willing to trade, but they're not going to initiate this trade. They're going to respond to the liquidity after the trade. So you need people to match buyers and sellers. That's where a broker comes in. To explain a broker, if a broker can get one buy-side client an hour and works 20 hours, it gets 190 ways to arrange a trade. So you can imagine that a broker works a lot, because the more a broker works, the more money he's going to make. He or she is going to make. There's the order exposure problem. Traders who know about impending orders can put block traders at a disadvantage. They can front run the order. They try to expose the orders only to traders that will most likely fill them. Now, if they can't find them immediately, they're going to have to shop the block. And that's exposing the order while searching for liquidity or traders. If they widely shop the block, they hang over the market and information is going to leak out. If you keep asking everybody, pretty much everybody's going to eventually know. So you can spoil the market. They can expose foolishly, and that price can run away on them. Strategies for a hanging block: if you do see one or run into one, you can front run it same-sided or opposite-sided. But keep in mind, if you're working with the block trader, you can get an untrustworthy reputation. If you do front run it, you can leak information about it. That's another way you can get an untrustworthy reputation. If you do this, you'll lose an opportunity to trade in future blocks, and you'll lose early access to information. There's a lot of money incentives out there to cultivate a trustworthy reputation while working with block traders. There's price discrimination problem. You do not want to see a price move against you. Meaning, if I was to trade with a block trader and he had told me that he had 500 shares left and I had purchased 100 of them, I would think of my position being 100 out of 500 left. But if that trader truly had 1,000 left, my position would be much different, and I would not trust that trader again. Traders want to see how much truly the large trader wants to trade. So block initiators convince liquidity suppliers the true size of their order, and they spend a lot of time doing so. You'll see them a lot within the anonymous markets. Traders cannot credibly reveal the true size. Traders can lie a lot because there's no negative consequences in an anonymous market, and they lie with impunity. They know clients well to keep honest ones. The SEC keeps that 13F holdings report and how much block traders have traded on, so there's a little bit of a backup. And you can use that information to estimate the maximum amount that large traders might trade. And this is a little tip, especially when a short sale is prohibited. There's the asymmetric information problem. That's trouble finding liquidity because the block liquidity suppliers suspect that they're well informed. Nobody wants to trade with a well-informed trader. And if this well-informed trader is very wealthy, they can invest more in information. Well-informed traders want to trade large sizes to get their maximum gains. They've invested in their information. They want maximum gains from it. Large price concessions are made so that traders feel a little more comfortable trading with these well-informed, wealthy people, wealthy traders. To solve the asymmetric problem, we can do a sunshine trade. Now, this is for really large traders. Convincing traders that they're uninformed is one way of trying to get around this asymmetric problem. They have to reveal their identity to do so. They submit an audit of trading intentions, of which we'll look at. But sunshine trading, it attracts front runners, matchers, and squeezers. But in return, this large trader gains liquidity, gains people trading on his instrument. LOR in the 80s is the most famous for that. Remember that there's wolves and sheep in this market. We play a zero game here. Uninformed traders are the sheep. Informed traders are the wolves. Wolves need to eat sheep to survive. Informed traders need to trade with uninformed traders to profit. There's programs out there called wolf detectors, but you can use the big old wolf detector up here as well. Block dealers take the client's position in their own accounts. So let's talk about a block dealer quickly. They play positioner and they play facilitator. Once that position is taken, they trade out of them. They can trade in large amounts or break them into smaller parts. So the block trader comes in, wants to get rid of what he has. The block dealer comes in, says, I'll take that position. So they purchase the entire position. Now that block dealer needs to trade out of it, either in smaller increments or one large amount, because they may have to cut it up. They're watching their transaction costs. So a block dealer really wants to pay attention to how much he's getting this block for. Block brokers, they ID traders to fill the dealer's orders. Now they're relied upon to determine if the block initiators are well informed and honest about size. If you screen the clients wrong, they're going to lose business. If they get lied to a lot, or if they lie back, they're going to lose business. So they have to know their clients well. Transaction costs are estimated. They collect commissions from both sides, dealers and suppliers. Now, really, a broker and a dealer, to separate them, in practice, they act as both. Dealers have more control of how blocks are sold, and a broker has more control of how blocks are assembled. But a dual is better because you can do what's best for the client at the moment. Trade reporting. Dealers must liquidate before the report is due. If they do not, they can show that they are well informed, or front runners can step into it. They don't really have to liquidate before the report is due, but if they don't, they're going to get front run. So they want to get it out. And now these due dates are different per markets. Markets with the weakest trade reports are dealer markets. And let's look at corporate bond markets as an example for that. To avoid helping a well-informed trader research clients' motives. Now that audit is what we're talking about, is a trading motive audit. And it's to avoid helping a well-informed trader research clients' motives. So we want to avoid helping well-informed traders. Okay, so you want to research the motive. When we find out that a large, wealthy block trader who has a lot of information is actually an uninformed trader, or they're trying to convince us that they are an uninformed trader, the traders are going to feel more comfortable trading with this person. But the trading motive audit is really just kind of a BS report. A lot of traders don't like it, and it's because block brokers are unreliable with the information and they're untrustworthy. If you want to see a stock trade happen, keep in mind that sellers initiate 80% of all block trades in the United States. If the block trade is close to the bid and not the ask, then it was seller initiated. So you have an 80% chance of that trade being a block trade. Equity markets. If a member of an exchange, they have to print their orders when the market is open. And that's to expose all the orders to market to protect the interest of the holders in that. In future markets, it's not as regulated. It requires that traders arrange all trades with trading systems, and that does prevent the abuse. Futures have no block trading procedures or cumbersome procedures. They use the EFP procedure because they can trade away from the market with this. Block traders like the EFP, and it's the exchange for physical. It's a long physical for a long contract plus cash. It's executed to get out of positions after hours. In conclusion, get to know block trading since it's the highest volume. Wealthy people, large institutions are block traders. Wolves feed on sheep. Never forget that. We are playing that zero game. A lot of information gathering. They want honesty, but they're going to lie with impunity when they're able to. You can tell a block trade by the stats. Now remember, no fear, no greed, no hope. And check my show out. I'm on atraderlive.com. Market open to market close. And have a great day.